Defiance has come out with a new income ETF called SPYT, and this one is interesting because it has a different option strategy and a different holding portfolio compared to other normal covered call income ETFs we have seen. So we'll do a deep dive on this SPYT, see how the option strategy fares out, and see if this might be the ETF we've actually been waiting for to retire us early with a nice 20% yield, as they say. But as usual, none of this is financial advice. I'm not a financial advisor.
Knowledge.
So what is SPYT? SPYT is trying to target an annual income of 20% in the S&P 500 using options, and it's planning to pay out monthly. So this is still an actively managed fund, but it's doing something different. They're going to use call options while buying another call option at a higher price. They're basically just doing a credit spread, and we'll go over that in the video. They're doing short-term options to offer an enhanced yield compared to traditional option-based strategies. This basically means they're trying to get more yield using 0 DTE options that expire in 1 day. They sell at the money or near the money call spreads to retain upside growth and to aim for an annual target percent of 20%. So what does this mean? If we scroll down to the top holdings, we can see most of their holdings are SPY. It says right now as it's over 100%. It seems like they use some cash because yesterday it was 98%. So maybe they dumped this cash into SPY. But typically most of their holdings are in SPY. That means if SPY goes up, most of their holdings are SPY. So it's going to track like the index. So it's going to have mostly the same downside risk and the same upside risk because most of their holdings, their net assets, are just holding the S&P 500. So the question is, why would I buy this if they're just going to be holding the S&P 500 for me and give me a 0.94 expense ratio, which is way worse than SPY and way worse than holding VU? The interesting part is these two portions right here. They're going to hold some First American government obligations, right? But they're going to hold some options for you, and this is where the money maker is going to come in. This is where you're going to get the income from. And this looks really confusing. I'll break it down for you. So SPX means they're using XPX to trade options. So while they're holding SPY, they're using XPX to trade options instead. And this is pre-market. We're like 5 minutes before pre-market at the recording of this video. And then you have the date they wrote the option. So today is 3/21, and they wrote the option for 3/21. And then you can see the strike prices here. This is 5,235, 5,220. And what this means is they sold 5 contracts right here because that's -5. And then +5 or just 5 means they bought these options. So how does this look on a credit spread? Let's check out this call credit spread right here. So the SPX price, what they're doing is selling a call right at the money, basically. They're selling a call and then they're buying a call above that. So there's a couple different areas you should know. If the stock price stays below where they sold the call or even slightly above it, this is where they make profit. This is where the money is. But by buying the call above, if it goes past the call price, their upside is limited. Their losses are limited because they bought the call, so it's going to offset the amount they collected. If this doesn't make sense, we're going to go over to more examples. Don't worry, I'll hammer this home a couple different ways. So what you need to know is they're selling a call close to the money of the SPX price, then they're buying a call a little higher. But since they're selling the call, they're collecting some money and they're hoping to give you that money. So how does that look on a profit loss sheet? You can see here, there is a break-even point at the stock price. If the stock price stays below that break-even point, you're in profit. If it goes higher than the price, you lose money. But your upside is limited because you didn't only sell, but you also bought a call, which goes up in value as the stock price goes up in value. So your upside is limited, but your profit is also limited. But this way you don't lose a ton of money if you have like a 3% day in SPY. And then if you're doing a call credit spread, you wouldn't get blown out on those calls you sold. And your upside wouldn't be as limited. And you see there are points of max profit and max loss. There is kind of this dead zone where you might only make a couple bucks depending on the spread. And we can check that in our options profit calculator. So let's go to credit spread. Let's get the XPX price. And then let's check their holdings. So they sold a call on 3/21. So let's select 3/21. We want to write a call for 3/21 at the strike price of 5,220. You can see that right here. That's their strike price. 5,220 is where they sold because it's -5. 5,220. But we have to change this right here. This is at the current market rate. Let's see what they got it at. So they collected $21.30 per contract. So 21.30. And then let's see what they bought. They bought a 5235 strike. So let's go up here. 21st, 5235. You see right over here. And let's see what they purchased. They spent $12.20 on this. And this is very different than the current market rate. So it's going to be a little different. So let's calculate. So when we scroll down and see the profitability, we have a very interesting graph. And this is the current share price, this line, and then up are the other share prices and down. You can see if it stays below about 0.11, 0.08% gain on the day, we will be in profit. Now it changes how much of a gain we can have. We can see if it's about minus 0.09%, will be a max profitability of $910. But if it goes up to 0.2%, they will lose $590 on the spread. And this is with their current fill prices, which is really impressive. I don't know how they got such good fills pre-market on XPX, unless I'm not understanding something, but that's what it is according to their sheet. So according to their fills on their website, this is their profitability graph, but it's just a better idea to see how if the price goes up, you lose money. If it stays even slightly up or down, that's where you gain money on a call credit spread. And that's what this sheet is trying to show right here. Up is red, down is green. That's your profitability right there. So we know the S&P 500 moves up over time. We can see that over all of its history, really. Some sideways markets, yes, but up over time in general. So will this be a profitable ETF? Most likely, since as of now, 100% of its holdings are SPY, but it's typically around like 98 from what I've been looking at. But the question is, will their option strategy, a call credit spread, be profitable? Will they just keep going up if this moves up over time, which is the thing to consider? If SPY moves up over time most days, will they just be losing money each day if they're betting on a bearish play? They're doing a call credit spread. You see right here, they're selling daily credit call spreads on the index, which is a bearish play. So it's an interesting stance. If we know the S&P 500 moves up over time, why would you sell a bearish play, which we can see on the graph? The price must go down for you to be in profit. So it's interesting. I don't know. Maybe it'll work. I don't know. Maybe most days are actually red. Maybe they did some type of analysis. But for me, that's just an interesting take on an option strategy to do indiscriminately, because they're going to be selling this every day. And they put it really interesting, guys. Each day, the fund will set a credit call spread on the index, focusing on options near-term expirations, which we went over. Selling an option at the strike price near the money, buying call above, that's the credit spread. If the index's value rises above upper strike price, the call spread cap, the fund will profit from further upside appreciation of the value of the index. So what does that mean? Even if we lose you money on our option strategy, at least you'll make money because we hold SPY. So, I mean, while it's true, it's interesting. Do you want to pay someone 0.94% for an option strategy that's unproven? Who knows if this works? It might. I mean, it really might. Who knows? But are you going to pay them just to hold SPY and play with an option strategy for you in the hope of getting a 20% yield? And I say the hope of because I haven't seen any other Defiance ETF, and I don't know why everyone's ignoring this. You see these three asterisks paid out monthly? The fund intends to pay distributions, if any, on a monthly basis. What other Defiance ETF has that? Okay, let's go to the popular ones, QQQY. They don't have asterisks saying maybe paid out monthly. Let's look at JEPI. They don't have asterisks saying maybe paid out monthly. Let's look at IWMY. They don't have something maybe paid out monthly. They got a 1. Let's see what that is. So it turns out IWMY does have this. The fund intends to pay distributions, if any, on a monthly basis. So we have this on IWMY, which has been consistent. So let's have some hope for SPYT, but it is just an interesting 3 asterisks that they put really plainly out there for you guys. So we'll see how this fund does. Of course, it's probably going to go up over time. I mean, it holds mostly SPY, but we'll see if this call credit spread strategy works. If we're just in a bull market, if it keeps blowing past the sell call and the buy call, you're going to be losing a lot of money each day. But if we have a sideways market or even a downward market, this will be a really good play. So the question is, if like in times in, 2022, if we're going mostly down, Would that be a good time for this if they're selling call credit spreads? Would that be a good time for this strategy? And only time will really tell. I don't actually know how this ETF is going to play out. I don't have my hopes up as with most Defiance ETFs, but I definitely think it's an interesting idea. So is SPYT really hold? It's really hard to tell. I think some markets, this option strategy might work. Some options, it probably won't work. Like the past year, if you're doing bearish plays over the past year, I think that's a terrible idea, right? So maybe some markets it will do good. Maybe some markets it will do bad. Really impossible to tell since most of its holdings are SPY, so it's going to appreciate and depreciate. But then also you have the options premium on top. If they collect any, like they say in their 3 asterisks, it tends to pay distributions, if any, on a monthly basis. So am I going to buy SPY? No, I'm going to stay away from this right now. You guys can do what you want though, but as of me, I'm not going to be dumping into the first month on this fund on the promise of a 20% yield, which we can see has not fared well for most of these Defiance ETFs. Are you going to be buying any of this Defiance ETF, SPYT? Make sure to comment down below. But if you're not convinced these high yield covered call ETFs are a bad idea, check out this video right here. Peace.